Because the statutory authority was not self-implementing, however, upon passage of EPAC in August 2005, the FERC staff immediately began work on preparing a Notice of Proposed Rulemaking, or NOPR, which was issued on October 20th, 2005. After reviewing and considering comments on the NOPR, the FERC issued on January 19th, 2006, its final anti-manipulation regulations. And these new regulations, one for natural gas and one for electricity, closely model Rule 10b-5 of the Securities Exchange Act of 1934, pursuant to Congress's direction that the prohibited manipulative activity should be consistent with the prohibited activity in Section 10b of the Securities Exchange Act. That direction was an important factor in the FERC's ability to quickly implement its anti-manipulation regulations and authority. The new anti-manipulation regulations promulgated by FERC are very broad, just like 10b-5, and are meant to be a catch-all fraud provision, just as Rule 10b-5 has been interpreted in the securities context. And while FERC's anti-manipulation regulations seek to draw on the large body of security case law under Section 10b and Rule 10b-5, FERC also recognized that the securities case law could only be applied as appropriate in the circumstances of each case because of the differences in the missions between the SEC and FERC. For example, the SEC, whose mission is to assure adequate disclosure in the financial markets and to protect investors, does not have the duty to assure that the price of a security is just and reasonable. The FERC, on the other hand, has a core mission to assure the just and reasonable prices for wholesale sales of electricity and natural gas, and for the transmission and transportation of those products. Despite these differences, the securities case law is available by analogy and thus provides guidance and certainty to the market participants who wish to avoid violating the FERC's anti-manipulation regulations within the framework of the FPA and the NGA. In developing and adopting the anti-manipulation regulations under the new EPAC, FERC was not writing on an entirely clean slate, since prior to EPAC, it did have regulations in place to prohibit market manipulation. In 2003, in the aftermath of the California energy crisis, FERC had required all market-based rate sellers to incorporate in their tariffs or authorizations a rule prohibiting market manipulation. However, because the breadth and application of the anti-manipulation provisions contained in EPAC were substantially greater, the FERC decided to rescind its prior provisions. In addition to implementing its new anti-manipulation rules under EPAC quickly, FERC also promptly issued a policy statement on enforcement, highlighting the factors it would take into account in determining civil penalties, which were also enhanced under EPAC. In this regard, FERC also looked to other agencies with more experience, such as the Department of Justice, the CFTC, and the SEC, and modeled the policy statement on enforcement on prior proven policies of its sister agencies. The FERC has not hesitated to put its new anti-manipulation authority to work to protect consumers. In July 2007, less than 2 years after EPAC was enacted, the FERC issued 2 orders to show cause for alleged market manipulation, seeking to impose civil penalties in excess of $450 million. And this includes the Amherst case, which is noted earlier today. Further, since the time that EPAC provided FERC with the increased civil penalty authority, it has settled 15 settlements, which include civil penalties of over $52 million. This concludes my remarks, and I would be happy to answer any questions the members of the committee might have.
Thank you very much, and again, we appreciate you being here, Ms. Watson. We're now going to hear from Mark Cooper, Director of Research at the Consumer Federation of America. We appreciate you being here to testify today, Mr. Cooper.
Thank you, Madam Chairwoman, members of the committee. The speculative bubble in the markets has cost the average American household about $1,500 in increased gasoline, natural gas, and electricity expenditures in the 2 years since the Senate Permanent Committee on Investigations first called attention to the problem. The Senate knew about this problem 2 years ago. It has cost the economy well over $500 billion in those 2 years. Worse still, it is now clear that the commodities futures markets have ceased to play their proper role of helping to smooth the functioning of physical markets for vital commodities like energy and food. Instead, they have become engines of speculation that feed volatility, amp up volume, and increase risk driving prices up and driving commercial traders out of these markets. Unfortunately, the CFTC and the FERC have failed to protect the public because they were slow to recognize a problem and are not looking for the real causes. While they look for a narrow set of abuses adopting existing case law, they ignore the much bigger flaws in the commodities futures markets. Energy commodities in particular are vulnerable to abuse, but they are traded in markets that are either totally unregulated or inadequately regulated. Prices are well above the cost of production. Risk premiums are high and rising. The market structure and behaviors are biased in favor of higher prices and against consumers. There is a pervasive pattern of past abuses, including manipulation of large positions, lack of transparency, structural advantage enjoyed by large traders, the exercise of market power, insider trading, self-dealing, and trading practices that accelerate market trends. Energy commodity markets are a recent phenomenon, and they have been plagued by inefficiency, manipulation, and rampant speculation throughout much of their history. Creating additional risk, which requires costly management, enriches the speculators and arbitrageurs, but does physical traders and consumers no good whatsoever. These markets need to be overhauled from top to bottom. It would be reassuringly simple if we could just blame the current speculative bubble on the blind ignorance, indifference, and ineptitude of the regulatory agencies. Just fire the commissioners and clean the problem up. The recent proposals that have been put on the table are baby steps that will not solve the problem. There are more fundamental problems that must be addressed. We have made it so easy to play in financial markets that investments in long-term productive assets are unattractive. We must turn down the volume by imposing more stringent conditions on these financial markets. We must not only close the Enron loophole, which allowed the vast swath of unregulated trading to take place, but we also must ensure vigorous enforcement of regulation and reporting. We must take back the authority we have given to foreign exchanges and stop abandoning authority to private actors. Large traders should be required to register and report their entire positions across all commodity markets. Without comprehensive reporting, there will always be room for mischief that is out of the sight of the regulator. Registration and reporting should trigger scrutiny to ensure the good character, integrity, and competence of traders. Failure to comply with these regulations should result in mandatory jail terms. Fines are not enough to dissuade abuse in these commodity markets because there is just so much money to be made that people will keep trying and trying. You have to throw the bad in jail. That's the only way you'll get the attention of all the people who know they can make a fortune by manipulating these markets. More broadly, we need to restore the balance between speculation and productive investment. Margin requirements and reserve requirements in organized exchanges are a fraction of the margin requirements on stocks. If it is cheaper to put your money into speculation, why bother with real productive investment? The margin requirements for commodity trading among non-commercial traders should be 50% higher than the margin requirements for investment in stocks. They should be more lenient for physical traders and commercial traders who really need to get these commodities into the tanks and to consumers. We must level the playing field between long-term productive investment and short-term speculative gains, with a tax on short-term capital gains between 33 and 50%. This will make holding assets for long periods as attractive as flipping short-term financial paper. If we do not do more than the approaches that are on the table, we will continue to lurch from crisis to crisis. The half-hearted reaction of the CFTC and the FERC are the regulatory equivalent of FEMA's reaction to Hurricane Katrina. Too low and too slow because the agency does not adequately appreciate the magnitude of the disaster. American consumers are suffering needlessly from the speculative bubble in vital necessities. It is time for thorough reform and re-regulation of financial commodities markets so that they can serve the American people, not oppress them. Thank you.